This changes everything. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the Israel conflict unleashes fear of the nightmare scenario. And what I want you to understand is when investors and speculators are at extreme positions and they're highly leveraged in those positions, it only takes an unexpected event like what's going on in Israel right now to trigger a massive feedback loop. And that's what I want you to see is a nightmare scenario that's about to unfold. Plus, we're seeing renewed signs of stress on the U.S. economy at a time when House Republicans are facing a crisis of confidence. And when it comes to the U.S. economy, as you'll see, confidence is everything. And well, if you're wondering what we're doing in downtown Dallas today, well, it has everything to do with a central banker. Let's over to Bloomberg, where we picked today's story up with a headline. The UAW says 4,000 union workers at Mack Trucks will strike today. That's on Monday. And this is just more stress on the U.S. economy at a time we don't actually need more stress, because this isn't the impact that Mack Truck is having. The issue is, what about those mid-tier and small-tier suppliers that feed into the factory? Well, they don't have the money. They don't have the credit lines. They can't keep workers standing around too long without enough activity to keep their factories open. And this is a big threat because, again, it's not just about the workers who are on strike. It's about everyone else who can't go on strike. Some 73% of UAW workers rejected the agreement, the union said in a post on Twitter, the formal social media platform now known as X. The strike will start at 7 a.m. today, and the union's claim include wage increases, cost of living allowances, and health care coverage. And I'm inspired to see the UAW members at Mack holding out for a better deal, and I'm ready to stand up and walk off the job to win it. That's UAW President Shawn Fain said in his post. And this is the time to strike. You know, if you're a union member, high inflation is what you're looking for to get those demands that you've been asking for years. It just makes sense that now is the time to do this. The problem is it's coming at it also at a time when the global economy is slowing down and we're seeing money dry up. And a lot of these small and mid-tier suppliers, they just don't have the money to go on a long, drawn-out strike, putting them at risk to not just lay off people, but maybe for some of them to find their way to bankruptcy. The strike action against Mack Trucks, owned by Sweden's Volvo AB, opens a new front in UAW's fight for better pay and conditions. Last month, it launched an unprecedented strike against the big three Detroit automakers as General Motors, Ford Motors, and Stellantis NV as Fain pushed for a whopping 40% pay increases over the next 4 years and a 32-hour work week. Weigh in the comments. What do you think? Is that what workers should have at the big three, or is that too much? I'd love to know what you think, because now as we head over to Washington, we're looking for a crisis of confidence here. Remember, we talked about, McCarthy's strategy going into these budget negotiations, that maybe he actually did want to see this thing get drawn out and see the government shut down and perhaps put Republicans in a position to take the White House if the economy was to enter a recession by the next presidential election. What happened? Well, was just the opposite of what we thought, because the polls said the Republicans would be to blame. And when it comes to that, well, that's why he's out. As House GOP sees Speaker vote on track as Israel adds to urgency, now we're actually seeing Congress do something because they have to get something done. But again, this is all about a crisis of confidence, and I want you to see, because when this happens in politics or the economy, when consumers or voters are not confident and they have a change in opinion, well, things happen. And here we're seeing it in the House, but I also want you to see how it affects the broad economy when consumers also lose confidence there. The speaker election took on new urgency this weekend after Hamas militants attacked Israel, killing at least 600 people, prompting calls for more U.S. assistance. But without a speaker, the House can't conduct legislative business, even with bipartisan support for Israel in the chamber. It's unclear what aid might need congressional approval, as Secretary of State Anthony Blinken said on Sunday that there was a tremendous amount of assistance already in the pipeline under an Obama-era agreement that provides Israel with $3.8 billion a year in defense aid. But he said Israel's also asked for specific additional help, and now we see Congress actually having to do something, which is pretty interesting because we know know they spend a lot of time not doing things, but that's kind of what their role is here. But you'll notice what they saw was the issue that voters just weren't behind a government shutdown. Again, crisis of confidence. But as we shift now to the U.S. economy, I want you to see why confidence matters so much, because here let's head over to the University of Michigan Consumer Sentiment Survey, which we know started to roll over. It's following potentially the conference board lower, but normally look at this. What happens when the consumer loses confidence? You see here in blue against advanced retail sales in red, shown on a year-over-year rate of change. Look what happens. You see a drop in confidence, and then retail sales go down. And so what you're noticing in simple facts is that consumers and their voters and their opinions matter at the highest possible level here, because as we look forward, you hear all this talk about crude oil, and we're going to talk about the effects of what's going on with Israel on the global economy at this time. But notably, look, when consumers lose confidence, what happens? You can see oil prices rising, and then they come crashing down because demand goes away. You see it here again in the dot-com bubble, the global financial crisis, the pandemic, and now we're seeing, of course, this big call for higher oil, which we'll look at and talk about what's going on in the conflict here in a little bit and why this matters and can trigger the nightmare scenario. And this is something that nobody wants to see, but I can show you just how close we are to it, because it all comes back to the consumer. The consumer loses confidence here, and I believe they will. Demand comes down, and a lot of things get unwound. And here we can even see on the treasury market, yields normally fall when confidence drops. Now, the question is, why does that? And you see here during the dot-com bubble, you see here during the global financial crisis, because what are we in? We're in a debt-based economy. We need consumers to go out and borrow money that they don't have, to buy stuff they don't need, and do it on credit, and do it now, and do a lot of it. So when their confidence goes down and their spending goes down, as I showed you with retail sales, well, how do you get that to turn around? Well, interest rates need to go down. So the problem here is, for one of the first times that we can find in history, is that we see confidence comes plummeting down, and at first there's a leg down in yields, and then all of a sudden everyone believes rates have to go higher because the Fed's hiking rates and will never stop hiking rates even. And what we see is the first disconnect, where we actually note that rates are rising as confidence fell. And we're going to say that as this rolls over, it's going to be a big problem, because if you think about consumers right now, we know money growth is slowing, we know the economy is slowing, and demand is going with it, and they're looking at higher interest rates, and they're saying, why should I borrow money for stuff I don't need when I can just park money in the bank? And that doesn't grease the wheels of our debt-based economy. So higher interest rates at this time are actually going to help push the U.S. economy and the rest of the world into a recession. And of course, that's one of the reasons I keep making the case that at some point yields are going to go down, and they're going to go below their recent lows, because they have to. They always have. It's going to have to juice consumption, because even the Fed, now that's why we're in Dallas, those Fed speakers, they don't get it. As Fed's Logan says, higher yields may mean fewer hikes. So what she's suggesting here is higher term premiums result in higher term interest rates for the same setting of the federal funds rate, all else equal. Thus, in term premiums rise, they could do some work of cooling the economy for us, leaving less need for additional monetary policy tightening. So what does all that gibberish mean in central banker speak is, hey, we're really finally happy to see the long interest rate, long into the curve. We wanted to see rates go up. We're finally seeing them go up. And because they went up so much here recently, we don't know what effects that will have on the economy. So we're probably going to have to pause at the next meeting, or maybe two, to see if it has any effect on the economy before we can continue to hike. So what you're now seeing is they're actually happy that long rates went up, but the question is for how long? Because on the other hand, quote, to the extent that the strength of the economy is behind the increase in long-term rates, the central bank may need to tighten more. And of course, we know that that's not true at all. We know it has a lot to do with the fact that hedge funds are massively short across the yield curve. And after last week, they came aggressively at the long end. We know the CTAs, machine positioning, because we talked about this on the Sunday show, are heavily maxed out short to the downside. Everyone's betting on higher interest rates. And so what do you see, goes on during conflicts is there's something called a flight to safety. We'll get get into this a bit more later, but if people come in and start buying the long bond, if you remember what we talked about on Sunday, it won't take much to get these machines to flip. And so you start to think about the nightmare scenario here is if all these people are short the bond market and it starts to rally, well, that means they have to go out and buy bonds to cover their short positions. The question becomes where they're going to get the money. But where you're going to get it is in your trading account, because I'm going to show you just how easy this is. So here's TLT. This is the long bond. And let's say you're looking and saying, you know what? I think this conflict with Israel is going to bring some buyers into the treasury market for safety. It's going to squeeze all these shorts, and it's going to cause a nice rally here, a tradable rally, but I don't know when to trade in. Well, I'll show you. If you had our CTA-Timer Pro report, this one from today, live report, you'll notice it's max short across our fast algorithm and our slow algorithm. These looking at machine positioning with a historical overlay, and you'll want to see it when this fast algorithm switches and you see buying to the up and covering the shorts. Well, that's your first indicator to take a position. Your second one, pair it with Momentum Timer Pro. There's a coupon code in the description below for a free month. How about that? When you see the daily flip to a buy and that corresponding move on the CTA report, there's your magic signal. That's what our best traders using these reports, that's how they're using them together. Links in the description for both of them, and they both come with a 14-day money-back guarantee. So when you see this setup, what do we tell our subscribers? Put this on your hot list, wait for the signals to flip, and then go. And now you too can capitalize on the central bankers being wrong. In answer to questions after his speech, Logan said, we have more work to do, and I think restrictive financial conditions will be needed for some time. Of course, as you know, we disagree with that in a big way because financial conditions are already tight. The problem is we had all of that pandemic stimulus going on. We had people that did not have to make their student loan repayments. That's back now. We're seeing a lot of factors that the Fed overlooked. And here you can see why as we continue this theme with confidence, because that's what it's all about. It's all about the consumer. And here we have the net percentage of domestic banks tightening standards for commercial and industrial loans to firms of all sizes. That's shown in red with the baseline for it at green. So you'll notice anytime the red line's above the green line, banks are tightening lending standards. Of course, we have consumer confidence still in blue. And notably, when you see the banks tightening lending standards, what happens? Consumer confidence eventually breaks and comes down. Why does that happen? It's because who creates the money in our financial system? It's the banks. And if banks are lending, that means consumers aren't spending, and that means they're not as happy because eventually they start to lose their job as demand goes down and they have to pay off their debt rather than focus on spending. And lo and behold, what are we seeing here now? You go forward into, of course, the global financial crisis, banks tighten lending standards. Well, there goes consumer confidence into the toilet. You see it now, but everyone thinks consumer confidence is going to make a rebound at some point. These tighter financial conditions, which they're already here, are going to weigh on the consumer. You're going to watch confidence come down, and the Fed is going to be backtracking in a major way. And that's why I wanted to show you that trade setup and how to use our reports, because it really is that simple. But many of you have been asking and saying, wait a minute, what's going on with Israel right now? How is this going to affect the global economy? Could this push us into a recession? The answer is yes, it is absolutely possible it can do that. The bigger concern I have here isn't that it would just send the economy of the world into a recession. Is could we trigger the nightmare scenario? We got the setup. I wanted you to see this. So we've talked about the bond market being mega short here. And what happens again is when people are short, they have to come in and buy to cover those in a rally position. So let's take a look what's going on here and how it could affect, as many of you said, what about the currency markets? What about the commodity markets? More importantly, what about the stock market? As Israel's latest army stops Lebanon incursion, calls up to 300,000 troops. The attack from Gaza-based militant group Hamas, which started on Saturday, has killed more than 700 Israelis, mostly civilians. Some 500 Palestinians have been killed in retaliatory attacks, as Palestinian authorities have noted. But here we can see what is the U.S. response. We've sent warships over, an aircraft carrier to Israel for potential support operations, and we can see that it is all about showing support. But there's a secondary reason here, because when we talk about the global economy, People often wonder is, why do we have troops in the Middle East? Why are we there? Well, oil's a big factor because we use a bunch of it. But why do we have our Navy over there? Well, some of you pointed out, what about global trade? And that's the key part here, is we need to keep those shipping lanes open because we need goods flowing out of Asia to get over to the U.S. so U.S. consumers can continue doing what they do best, and that's buying stuff that they don't need from other parts of the world. And that's the issue here, is why we may not see a big reaction in the equity markets just yet, is because as long as the supply chains remain open and those waterways are there and ships can move, well, that means the U.S. consumer can continue to buy. But what about oil? Everyone's calling for higher oil now as oil climbs as Israel attacks spur flight to safety. We see crude futures rising more than 5% before pairing some gains this morning as geopolitical risks are back in focus amid the attack in Israel. We expect short-term volatility in the stock market and oil market as investors digest heightened tensions in the Middle East. And what haven't we seen so far? A big drop in the equity market. Why? Because it doesn't really change what goes on here for the U.S. consumer. Now, the rising price of crude oil is an issue. But one thing we've noted during conflicts, and this even happened during the Russian invasion of Ukraine, we saw oil pop up, and then it reversed after a while. It just wasn't sustainable, because if we come back to the U.S. consumer, we focus on what is their spending on rent, on food, and on energy. And if energy prices go up, what that means is less money for discretionary spending. That means demand goes down. It doesn't matter if those ships get over here from Asia because nobody wants to buy it. And when you see demand go down, what happens is oil prices eventually follow. And that's why I don't buy into the view that oil prices are going to go way up. But you're going to see a lot of headlines like this as oil spiked well north of $150. Here are the main implications. And of course, hear this from Zero Hedge. In response to the sudden war between Israel and Hamas, which could escalate and potentially drag in states such as Iran, Goldman's commodity desk has laid out thoughts on how the oil market react, and that is their call to $150 a barrel, if you can only imagine. But nevertheless, we tend not to see this because, again, it all is a much bigger picture than just the supply component. It's the demand component, and we know that U.S. consumers are indeed tapped out. But from a central bank perspective, from a policy perspective, well, it could easily drive inflation higher here. And then we've got the consumer price index in blue overlaid against U.S. regular all formations gas price in red, both shown on a year-over-year rate of change. So we have the consumer price index coming up this Thursday, and based on at least gas prices alone, it would suggest that the consumer price index could go up. What we're going to find out is how much demand on the non-energy side actually went down, and that's going to be a bigger factor here. Because as we look at the scenario here, as you start to get this up, we have the bond market short, we have the potential rally in the energy market that will tap out the U.S. consumer even more. What about the dollar? Well, if you got it, you see effects too, because the shekel stabilizes after the Bank of Israel threatens a $45 billion intervention here. And the issue here is the shekel tumbled overnight, down over 2% against the dollar, pushing the dollar even higher. And so you see this effect in the currency markets, also in a higher dollar. Not good for the U.S. economy right now, not good for the U.S. manufacturing sector. But what this is an issue is it's demand for the shekel. That's what this is. And everyone says, hey, if you're in the middle of war, who's going to want to trade or do as much trade with you? Demand for your currency is going to go away. And that's why we're seeing fall in value. Of course, the rising dollar putting more pressure on the U.S. consumer and the U.S. economy and helping the Fed out. But economic activity in Israel will likely be disrupted, no surprise, presenting a negative supply shock. And at the same time, fiscal support will probably have to be stepped up for both reconstruction and loss of income support, as well as strengthening security measures. A wide-scale call up of reservists could further reduce labor supply in an already tight labor market. and this could be partially offset by job destruction in areas affected by the fighting. But on the demand side, a lot will depend on the general threat perception, which might weigh on consumption in sectors like hospitality. Absolutely is going to weigh a big time on hospitality. But what does all this turmoil in the markets lead to? Well, it leads to a flight to quality. And now we get to the nightmare scenario is you have all these people that are short the bond market. You get a rally here because there's a safety trade. They have to come in and buy bonds. But remember, liquidity is light right now. There isn't a lot of money being created by the financial system. And so if these people who are short don't have the money to buy the bonds because they're so short, that means they might have to start selling equities. So if they start selling equities, next thing you know, volatility goes up. As volatility goes up, equities go down, bond prices tend to rise, causing further pain on their short bond positions, meaning they've got to cover more of those to sell more equities to cause volatility to go up. And next you know, the wheels start to spin faster and faster, and you get a massive unwind as the machines. Of course, we haven't seen the vol control machines sell yet, but if they do, you could see a big blowout in volatility here, a huge collapse in rates, all because people are in extreme positions and they're extremely leveraged on a setup that they thought was just based on the economy. But sometimes it takes one outside event, such as, of course, the conflict in Israel, to trigger a massive feedback loop, which is what I think could be coming very soon. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.